Hello, everybody, and welcome to the Investing with IBD podcast, sponsored by Direction. It's Wednesday, May 5th, 2021. It's Cinco de Mayo, and I'm Justin Nielsen, the head of market research here at IBD. And I'm joined by my co-host, Alyssa Coram, IBD's multimedia content editor. And today we have as our special guest, Chris Retzler. He's joining us, and he's a managing director, executive vice president, and portfolio manager for Needham Asset Management. So on today's show, of course, we're going to be talking about the current market and also what's going on specifically in the small cap space. And we'll wrap this up with taking a look at a few ideas from Chris. But before we get to Chris, Alyssa, why don't you tell us a little bit about what's been going on with the current market?
That's right. So as we saw on Tuesday's session, the NASDAQ took a very hard hit and the bleeding continued today with the NASDAQ reversing lower, pulling closer to its 50-day line. We still have the distribution day count remaining at 4 on the NASDAQ, 4 on the S&P 500. Relatively quiet session for the S&P, and the Dow is hitting highs. So we're seeing this bifurcated market sort of rear its head just when we thought that we were going to start just trading nice and quiet and sideways for a little bit. The NASDAQ getting hit pretty hard this week, Justin.
Yeah, and small caps too. If we pull up the Russell 2000, this is something that was having such a phenomenal run. This past year off of the lows in March, and then especially heating up after the election, the presidential election in November. Chris, this is your wheelhouse right here, since you are a small cap fund. Tell us a little bit about what you're seeing in the small caps right now. Is it anything that you're concerned about, or is this just kind of the normal correction you would expect after such a strong move?
Well, I think what we're witnessing is a lot of rotation within the small cap universe, where growth names really outperformed last year over the value names. And what we were beginning to witness at the end of last year was a greater appetite for recovery plays. Those industries like energy, where people go back and there's more travel. So those oil prices were coming back that lifted those names. What we also saw was an increased risk and discussion around inflation. And that is what has caused the interest rate yield curve to steepen. And that really benefited a lot of financial companies where they can borrow cheap and lend. And that's benefited, again, the value side of the universe within the Russell. Where we focus and spend a lot of our time is more within technology, healthcare, a little bit higher growth, but we have more of a GARP strategy. So we're not looking for the high multiple names, which also were severely impacted more back in the February, early March timeframe of this year, where interest rates spiked and accelerated on that spike, thereby causing a depression in the valuation multiples for some of those really high multiple names. And that generally, was in a lot of the software names, a lot of the work from home names, and they've been going through a relative correction since then.
Right. So for that growth at a reasonable price idea, when there is a little bit of this mean reversion, do you switch at all, or how do you kind of handle that?
Well, we try not to style drift. We know what we know, and we like to stick with that. It has helped us in the long run. And so what we will do is we will rotate out of some of our more concentrated names that have done well. We also do hold cash, and I know many folks don't like holding cash, but we very much view it as a strategic asset, where small cap companies, as we say, trade by appointment many times. And so you need to have that cash available for when those shares come to market. And if you've done enough due diligence and enough work, and you know what you want to own, and when those opportunities arise, having cash is critical. We've been very good at that over the years, deploying that capital strategically. But beyond that, we really do try to stick to the areas we know best. And that's more in the growth area. And again, looking out as a long-term investor, we're pretty confident that the growth is still out there.
Yeah, and I think there's definitely something to be said about sticking to what you know and really just wielding the power of the sword that you have. And I want to go back to your statement about this rotation out of these growth names and into these recovery plays. How much longer do you think that this is going to play out? And then I guess, taking a step back from a macro level, what are some of the things that are impacting how this is going to play out?
So it's always hard to tell when the top, comes with a rotation, but the reopening trade plays, hospitality, travel, transportation, it's all wonderful. I mean, it's great because it's broadening out the market. And we think that that's a very positive occurrence for a longer term continuation of the bull market. We're coming out of a very deep and quick recession that we had last year. And typically bull markets last a lot longer than just a couple quarters. So while we see this rotation and it's not helping small cap tech at this, very month and last month, we don't though foresee a stumble in the economy. We see a continuation. We've seen the pull forward of the digitization of the economy, which has put a lot of pressure on certain industries like semiconductors. Mm-hmm. We have a major supply problem right now with semiconductors for a variety of reasons that we could go into. But quite frankly, I don't think we've ever seen anything like this where there's so much demand on the other side for finished goods that we don't have enough semiconductors. But it also tells you and shows you the digitization in where semiconductors are in almost every industry, whether it be transportation of electric vehicles, medical devices, industrial, defense, computers, laptops, communications, they're everywhere. And we think that trend continues. And it's really some good long-term secular growth areas that we think value. They're coming into more value periods that we would be deploying capital.
So to kind of get back to this idea of some of this digitization getting pulled forward, I mean, what immediately comes to my mind is like with Netflix, during the pandemic, all the subscribers were kind of joining Netflix and they were saying, look, we're meeting our subscriber numbers. They're just getting pulled forward to an earlier quarter. We still have the same numbers. They're just getting pulled earlier. How much of this do you think is kind of priced into the market, some of this pulling forward and the expectations for these reopening plays as more of the population gets vaccinated? So how much of that is getting priced in, pulled forward? How much does that leave, potentially, I guess, lackluster when it actually comes to pass?
So I think the growth rates for a lot of the companies that worked very well last year, I don't think you have a repeat of that growth rate, which were quite accelerated and concentrated. Netflix, everyone was home or working from somewhere other than their office, and they were utilizing a lot of these services, Zoom, other sorts of communication tools that optimize their ability to be outside of the work office. And Netflix certainly had a good run on that side of it. But I don't think that people are going back to their historical ways of getting media delivered to them. I think that Netflix has now a land grab, let's say. And then you say, what is it that you do next? Do you continue to build great media content that you can put through that platform? Do you add other services? And that takes time. And so what we're seeing is now people are going to be getting on airplanes, and hopefully they're going to be getting, on cruise ships and into hotels and other services. And I think that that's what we're seeing right now. But I don't think we're going to see a backpedaling of some of these industries that did very well, like a Netflix. And again, that's why I'm saying it's broadening out. There's just a lot of demand out there. Do people go back to movie theaters as much? I don't know. I mean, that's probably a big question, because if I can absorb my content sitting at home or wherever, do I need to be there? I can see teenagers and others who feel the need to be in a movie theater. It's just a social thing that they do. But I see that the economy has changed quite a bit. So again, I'm very bullish on the recovery, and the broadening out, I think, is again healthy for the equity markets.
And when it comes to the small cap space, talk to us a little bit about more of the trends that you're seeing in that area, especially when it comes to the M&A environment. How's that playing out in 2021?
So M&A always is a good thing for small cap companies, as larger cap companies look to buy higher growth companies or to bolt on businesses. And right now, we haven't seen a lot of M&A in the small cap universe, but we have seen some M&A in the middle, kind of mid cap area. And that's very healthy. CEOs do deals when they feel that over the horizon, the economy is still going to be good. And I think that portends well for what we may see as a lot of these smaller cap companies get absorbed. We call them terminal trades. And the capital then is redeployed. So we do think we will see a higher M&A activity throughout the remainder of the year. One driving force that could cause this is the potential of higher capital gains tax rates. For founders and entrepreneurs who would like to think that the tax rates, if they go into effect, that they go into effect in January of 2022, they'd like to conclude and close their transactions before the tax year end. But that said, there's also a lot of cash out there. We've seen a lot of money raised. Corporations have a lot of very strong balance sheets with cash on. And so they can do accretive deals. There's typically a lot of cost savings that can come out of smaller cap companies that are burdened with the costs of being public and the board and a lot of other expenses that can really be stripped out. And if those small cap company products or services are on a larger platform, those larger companies generally can do a lot more in a shorter time frame than a small cap company could do on their own. So there's a lot of dynamics there. We think in our portfolio that we have a handful of names that could be great candidates for acquisition.
Well, as part of that research that you do, is there something in particular that you look for in the technology or innovation that a company is doing that you think, hey, this is something that might be small right now, but is ripe for an acquisition? Or is it just one of those things where you just pick good companies, and if they get acquired, so be it? Lucky you.
I think that the M&A aspect of how we invest is really a second or third part of our decision. First and foremost, we spend a lot of time with management teams, and we think that is the critical piece of our due diligence, getting to know management, observing their board, what's their history, how have they performed in the past, have they done, what have they done with other transactions and businesses in the past. The second piece that we also look for is what's the strength of their moat, their technological moat, for example, or the moat of their service. Is it something that's repeatable by a competitor, and what's the cost to do that, and how defendable is it? In technology companies, there's always a lot of lawsuits defending patents, and that's actually defending your moat. And so while costly, typically when you win in those cases, it provides you a nice runway. But I would say management and strength of what is the product or service that they're providing are really the forefront of where we go and spend our time and then make investments. Now, if M&A occurs, that's a wonderful outcome. Sometimes it occurs faster than we would want, just from a runway that we thought that they could go a lot further, or from a tax basis. But we have to move on. There's a lot of companies out there. That's a great part of small cap investing. There's so many of them. And it's what we love to do. I mean, we get up every day and meet companies and meet managements and really try to dig in and say, are you selling picks to the miners? And that's an area that we really like. It's a strategy that we have applied for a lot of years, and you can apply it in a lot of different industries.
Well, Chris, I know we're just scratching the surface with you. We have a lot more we want to cover, and we'll get to that right on the other side of this break. So we'll be right back.
The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive.
Welcome back to Investing with IBD, sponsored by Direction. It's Ali Coram here with my co-host Justin Nielsen and our guest, Chris Retzler. So Chris, where we left off in the last segment, you were talking about how that relationship with management teams is something that is very key to doing your research. So how can retail traders implement that sort of mindset when they are researching companies?
I think the first place investors can begin is really with the quarterly calls that all investors have access to. I'd also say that, investor relations in general, if you were to send in an email or call them, they're generally pretty responsive. Certainly the smaller cap companies probably don't have as much inquiry. So for an investor, that's what they're there to do and to support their shareholders, whether they're big or small. So, but the consistency of quarterly calls, you do want to remain consistent where you listen each quarter to say what has changed, somewhat like investors do with the Fed. Each time they come out and said, what sentence changed, what business, were they talking about, and now they're not talking about. You also get the benefit on these quarterly calls of a lot of sell-side research analysts who ask the questions that they've been hanging around the hoop long enough to know that those are the questions that are probably the incremental information that investors want. So you can leverage off of them as well.
So you kind of mentioned a little bit about the Fed, and certainly a lot of people have been focused on rates, inflation. Just this week, Janet Yellen had some comments on what she was seeing in terms of inflation and the potential for raised rates. She kind of walked back some of those statements, but it certainly rattled markets a little bit. In that macro perspective, I guess, what are you seeing there with the Fed, inflation, and the economy writ large?
So we are seeing inflation. That is true out there. We're seeing commodity inflation. We're seeing inflation within the supply chains of technology for products. There's supply constraints, and the question is are they going to raise prices? But there is inflation. Oil prices are up. But when you compare this year over last year, when we were really at the depths of the pandemic and just beginning to come out here in May, you would expect that year over year inflationary numbers to spike. That's just the way the numbers are calculated. I think what investors need to evaluate is how long does this persist? And I am a firm believer that the market has many ways to correct itself naturally. Do you bring on more supply? How long does it take to bring on that supply? Are there other things that can be done? It's been mentioned that you drop tariffs on Canadian lumber. Does that bring down the price of lumber for the real estate market that right now is facing higher input costs to build a house? Or do people decide not to build the house because it's just too costly? So it naturally corrects. The automotive industry, for example, with semis have pulled back on a lot of the car lines and truck lines that they just aren't going to build right now. And so that in itself somewhat corrects the semiconductor shortage, because what they're doing is going after the higher margin business or those products that they know they can finish, they have enough supply, and it's a temporal issue. So then what happens then? Used cars come onto the market. Avis and Hertz start selling their fleets because people aren't renting cars. Those are used cars. They go into a CarMax and other used car industries. And it just filters through, and the market has some self-correcting factors. That's great. I mean, and that's what investing's about. You follow those trends. You follow, the process of what makes common sense, quite frankly. I mean, that's, you can do all this fancy modeling and work. Sometimes investing is just really about common sense. And so that's what we're looking at on that front. But, an area that we have a lot of investment and we have high hopes for is the semiconductor area.
Yeah, let's talk about that a little bit more, because it really sounds like there's a huge domino effect that's happening right now that is very far reaching, and probably more far reaching than the average retail investor may realize.
Yeah, so semiconductors are, as we mentioned, are pretty much in almost every device at this point in time. The digitization has expanded their usage. But there's some other factors going on. One is the capacity at the foundries is limited at this point in time. But there's also geopolitical reasons and national security reasons that you're hearing out of the White House talking about providing some funding for the semiconductor industry to bring home that manufacturing. Years ago, we used to do 35 to 40% of the world's output, and now we're not even close to that. And so there's been discussions with companies like Intel, Taiwan Semi, Samsung, to expand and build out factories here within the United States again. I personally think it's fantastic. I think it's going to bring home and create a lot of very high-paying jobs. It also creates an atmosphere, an environment where there's a lot of other industry businesses that are going to have to supply those factories. You can almost think about it like an aircraft carrier, where the aircraft carrier has all of the planes, but there's all these service boats and other suppliers surrounding it and providing the support. And that's what would happen with these foundries. Foundries consume a lot of gases, clean gases, other materials that go into it. There's other services, ventilation. I mean, just it goes on and on, the amount of industry that goes into a factory, which is why they cost $10 billion to build one. The problem is they take about 3 to 4 years to build. And so there's no real quick fix to the semiconductor supply situation that's out there. And that's why I think it's going to be more market forces that correct here in the near term, the supply and demand mismatch. But going forward, bringing that home, I think, is going to be great for the United States. It's going to be great for a lot of high-paying jobs. And I think it'll also help on a national security basis, where our defense industry needs a lot of these chips. So there's a lot of reasons, and I'm very bullish on that front. Semi-cap equipment manufacturers also should benefit, because when you build these foundries, you have to supply these very expensive machinery, and it takes some time as well for them to ramp, for the amount of capacity that we think is going to come in. But companies like Applied Materials, Lam Research, they should all benefit long term. Historically, they've been more cyclical, but what we've seen over the last, say, 5 or 6 years, and I think going forward, is they're going to behave more like true industrial companies, but higher growth industrial companies. So there's going to be less cyclicality as this gets deployed. And I think that that's a real benefit to a lot of US companies.
So there has been a lot of strength in the semiconductor industry, but it seems like it's taking a little break right now with all these positive things. Is that just a temporary resetting after moving up so much, or is some of these things just need to be figured out a little bit because there's so many years out for some of this stuff to happen? Or what's your feeling on what's going on with the semiconductors right now with their current correction?
Yeah, so you actually touch right upon where the semiconductor industry went over the last 20 years, is they went to more fabless,
Right.
So many semiconductor companies we talk about don't actually manufacture. They outsource it to a Taiwan Semi
Right.
or a Samsung or an Intel. And so the constraints are at the foundries of those companies right now. They are not going to become, the fabless companies are not going to start creating their own factories. But what we need is more capacity on those lines. And so you have cutting edge, front edge chips where an Apple would be looking for very small nanometer to go into phones, small, compact, power consumption, optimization. But then there's other older lines, which really go into the industrial, medical, automotive. And that's where there's been a bit of a jam, because you're not going to run your very expensive, cutting edge lines for these older chip designs. And so that's what needs to clear out of the market. But what we're seeing, though, is other companies that are suppliers to those lines are having actually pricing power that they've never seen in the past. And that's, where we've been investing and finding some names that we think are going to benefit here as this supply constraint kind of gets cleared. But I think it's going to take, a quarter or two. And we heard from GM today that they think it's maybe in the third quarter. I think it's going to be a couple more quarters than that for the overall market to clear, probably somewhere into 2022.
Yeah.
Well, you mentioned some of the names that you're looking at. When we come back, we'll take a look at some of the names that are on your radar and how you go about getting into them when they are the smaller companies. We'll be back right after the break. The Direction Hydrogen ETF offers exposure to the top 30 pure play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Welcome back to Investing with IBD, sponsored by Direction. It's Justin Nielsen here along with my co-host Ali Coram, and we've got our special guest, Chris Retzler. And after the talk that we've had about semiconductors and a lot of the stocks that you're looking at, it probably makes sense for us to take a look at your fund growth that you've had over the past few years here. Really remarkable, as the small caps have really come on strong lately. And so this is the Needham Small Cap Growth Retail, NESGX is the ticker symbol on this, and we're showing the MarketSmith chart monthly in this case. Do you want to talk a little bit about what's been going on in the last few years?
Well, the last few years have certainly been good for small caps. We've taken an approach, as I mentioned earlier, where we utilize cash in a strategic way. So we've had a little bit more flexibility, where we try to concentrate our best ideas in our top holdings, which, our top 10 at times can be close to 50% of the fund. But we're also willing to take some of our profits off the table where we're flexible. It's been a tough area for small caps to, have really extended growth for a long time. And I think that for even a long-term investor, there's nothing wrong with taking some profits at times. But to the extent that we do as much due diligence on our companies, we also then redeploy that capital at times when you hit a rough patch or a tough 2 quarters where management and they're just going through some growing pains. Not always does the market have patience. What we look for are investors who probably have at least a year-long investment horizon, because you do need to have patience in some of these, and things don't always just occur, every quarter. So, that's where we've been doing very well. We've been growing assets, and we continue to stick to what we know best. We really don't try to have any style drift.
Well, let's take a look underneath the hood here, Chris, and chat about some of the individual holdings here. So PLAB, Photronics, talk to us about what stands out to you about this company, which definitely fits that semiconductor theme.
So Photronics is a critical supplier into the semiconductor industry where it makes products called photomasks. And so for every new chip design, you need a photomask. And right now, for the first time they've seen in decades, that they have some pricing power because the amount of demand for photomasks is just beyond what there is for supply. They just finished a lot of investment in building out some of their factories. So they've turned the corner to be a cash generator from a cash deployer or investor. And we think that they're now on a pretty good runway for, I think, the next couple years where they're going to benefit from this recovery. And they stand really at the crossroads of semiconductors, and we think they're going to be benefiting from it.
Mm-hmm. And let's go ahead and turn our attention to just briefly IVAC, and the symbol on that is IVAC. And tell us a little bit about what attracted you to this and what you're seeing out there now that maybe is interesting about it.
So there's two parts to IVAC. First is the historical business, which is supplying the hard disk drive industry, which we think is going to begin to deploy capital later this year. But the real highlight that they've been working on is an image sensor, which ultimately we think will be incorporated into the very large Army contract that Microsoft just announced they received in the last quarter. We think that as that ramps, that they could produce, IVAC will provide night vision equipment into that contract. So again, we're trying to sell picks to miners.
Right.
And this is an example of that. They just had their earnings call yesterday, so I will note that they just said that they hired an investment bank to explore strategic alternatives. So I think you need to be patient and see what comes out of that.
Right. And speaking of which, this is a pretty thin company. So how is it that you as a fund, can build a position in something where it's a $6 stock and doesn't trade very many shares a day?
So again, this is a perfect example of where you need to have some cash to be able to be there when stock comes to market. Stock comes to market for a variety of reasons. Did an analyst leave another competitor fund, and so they're just liquidating the position? Is there an equity offering? You need to have cash available. So over a period of time, we've been accumulating our investment here, and this is a long-term investment. This is not something that I would suggest if you're a day trader to be involved with. It needs patience. And we think now that, the news that they've been able to provide at the last earnings call and the hiring of an investment bank, we think that there's some real upside here in the next year and a half.
Well, let's shift gears here a little bit and talk about Aspen, ticker ASPN, in the chemicals sector, which we've been paying close attention to over the last couple of months. And they specifically deal with battery technology. So can you tell us a little bit more about the story with this company?
Yep. So there's two parts to Aspen Aerogels. One, again, is the historical business of providing insulation to the chemicals industry and energy industry. It's a very high performance insulation. It's not what you would think of putting in your house. It's very thin, it's very lightweight, and it's also not impacted if it gets wet. But the other business that they've been developing, which I really think is the high growth part of the business, is their thermal runaway technology that can be used in electric cars and electric batteries. So the technology helps electric cars, maintain and control heat that comes out of the batteries. And also in containing that heat, it helps to extend the life of a battery, which in a car means more miles driven on a full tank of a battery. So if you have a car at this time going 300 miles on a full charge, Aspen would be looking to help expand that mileage. And we think that they're working with many great battery companies out there. And we think that this technology is going to expand over the next couple years. They are looking to build out their capacity over the next year or so, and we think that it's really great upside that they're looking at going forward.
So a number of these companies that you just brought up, they don't really have earnings growth right now or sales growth. How important are the fundamentals to you? How important are those growth numbers, or is it something where you're looking at the story and the future and kind of projecting out what could be?
So Aspen Aerogels actually went through a patent suit, as we were talking earlier, with the technological moat, and they were able to defend themselves on a global basis. That they're going to be a product of record, we call it. And so then once developed, that's the technology that needs to go into the ultimate product. So you have to look out further than maybe just a year for this growth. But to remake what it is that they have today, we think that there's a lot of value here.
Okay, and let's go ahead and wrap up the discussion with a look at 2.6. The symbol on that is IIVI, referring to the periodic table of elements. So, break out your chemistry book. What is it that you like about this company and this latest acquisition that they've made?
So IIVI has been a holding that we've known a long time, management team that we have a tremendous amount of faith in their ability to execute. And again, this is where the knowledge of management is so important. So they have just recently won in a competitive M&A, purchasing competitive bidding, that they were able to win the purchase of Coherent. And we think that the management team, has execution risk of integration, but we think that they are the most capable team that can do this. They've done it before. It also transforms the company where we think that there'll be some substantial multiple expansion as they move from more of a mid-cap to a large-cap company. They've been expanding their businesses beyond just their materials, the specialty materials that they've always been known for within the laser industries. They've been now moving into, over the last 5 or 6 years, the optical space, and now adding in Coherent. It only helps to overlay and expand further their depth in the businesses that they're already in. So this is one of the 3, in my opinion, big M&A transactions we've already seen this year. And again, a CEO who can see over the horizon probably better than investors is telling us that they have a pretty good, positive, bullish outlook on what they see. So stay tuned. I think as the deal closes later this year and the integration process occurs, we think that IIVI is going to be very well rewarded for their investment here in Coherent.
Well, Chris, I think a great way to wrap up might be to just touch on, once again, you talking about the importance of not having that style drift and really sticking to what you know and what you do best, and how that pays off in the long run.
Yeah, look, I think investors need to have patience in what they're doing. And we're in an environment where a lot of people like to day trade or buy Bitcoin and it goes up 20, 30%. But I think for equity investors, and certainly in the small cap industry, you need to have a strategy. And I think you stay in the lane, what you know best. It helps you know when to buy, and probably more importantly, when to sell. And as I mentioned earlier, we've become more flexible, where we're willing to take some profits off the table when necessary. In my opinion, it helps to reduce the risk. And in an environment where liquidity is moving around and volatility has been increased, investors really prefer more consistency. And so that's what we try to provide as best we can. But don't lose faith. I think the U.S. economy, I think the global economy is going to recover. It's going to be big. And I just wouldn't be short the U.S. at this point in time.
And Justin, I would love to get your thoughts on this subject too, while we're at it.
Just the broad economy, or
So,
what
no,
specifically? Well, I mean, I think what he's talking about. I mean, the idea of, you know, you have to have that strategy and you have to stick with it. I mean, that's the whole benefit of having rules, because what's very easy to do is kind of look, you know, grass is greener over on the other side, and you start shifting too much, and, you know, oh, I'm gonna go in this lane because that lane looks faster. But then, you know, this happens all the time on the 405 freeway, right? You change lanes and then you're slowing down. So I think a lot of what Chris is doing here, that moving, you know, being willing to sell some of your profits, kind of take advantage of that mean reversion, sell your profits, sell into strength, and then, you know, be patient with some of these. It's very different what, you know, from what our typical style is, because Chris, you're really comfortable with dollar cost averaging. It's part of your business. You know,
Yeah, but I think one other thing that is different in the last 10 years is to take advantage of passive investing. Where passive investing has a bucket of stocks. And if you've done your diligence on some that are within that bucket, and if they sell off in a way that's not justifiable, but it's just being done because of its inclusion in a passive index,
right,
active managers can take advantage of that. And again, that's part of the flexibility you need.
Wow, you just opened up a whole nother can of worms here, Chris, where we could get into the whole active management versus passive management and how ETFs have changed the landscape there. But we'll have to have you on again.
You back. Yeah.
Right.
Thank you.
And coming up next week, Arusha Pires, the former host of this show, is now going to be in the hot seat, Justin. Can't wait to ask him all the questions. We're excited for his return to the podcast. Arusha, he's portfolio manager at O'Neill Global Advisors. So don't miss it next week. That's it for this show, and we'll see you next time.
And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.